Welcome to the Explainer. What if the very act of us watching the financial markets actually changes them? Today, we're diving into George Soros' theory of reflexivity. And let me tell you, it's a powerful idea. It basically argues that market prices don't just reflect reality, they help create it.
All right, let's kick things off with a pretty fundamental question. Most of modern finance, right? It's built on this idea called the efficient market hypothesis. The theory is that prices reflect all the available information out there. But what if that's not just wrong, but a dangerously incomplete picture of how things really work?
So the conventional view is kind of like this. The market is a passive mirror. It just reflects what's already there, the economic fundamentals. But Soros, he came along and said, no. He argued it's more like an active engine, an engine where prices themselves can actually reach out and, reshape the very reality they're supposed to be showing us.
And that right there brings us to his central idea. This is really the core of his entire philosophy. It's a concept he called reflexivity.
Okay, so here's the absolute crucial point. Think of it like a two-way street. It's not just reality affecting prices. Our beliefs, our perceptions, they shape market prices. And this is the fascinating twist, those prices turn right back around and start to shape economic reality itself. It creates this continuous feedback loop between what we think is true and what becomes true.
But what really powers this whole reflexive engine? What gets that feedback loop started in the first place? Well, it turns out it all comes down to something deeply, deeply human.
Soros had a name for it, fallibility. And it's a really simple, undeniable truth when you think about it. Our understanding of the world, it's always incomplete, and it's almost always biased, right? None of us has perfect information. We all come to the table with our own flawed perspectives when we decide to invest our money. And this is a brilliant illustration of how that loop actually works. So we start with a biased belief. Let's say tech stocks can only go up. We act on that belief. We start buying. All that buying pushes the prices higher. And what happens then? Well, the companies look more valuable, which lets them raise more money. This new reality then seems to confirm our original biased belief, and boom, the cycle just keeps on going.
Let's take a housing boom, for example. It's a perfect real-world case. It all starts with a simple belief. Home prices are just going to keep rising. That encourages more people to buy, right? Which of course pushes prices up. And then, suddenly, those homes are worth more as collateral. That means people can borrow more money against them. All that new money floods into the economy, which then seems to justify the super high prices. The perception literally created the economic reality. Okay, so let's look at what happens when this engine starts to overheat. Because this reflexive loop, it's the very mechanism that creates those dramatic, boom and bust cycles we see all throughout financial history. Because what goes up reflexively, it often has to come crashing down.
So Soros basically saw markets as existing in two different states. You've got your near equilibrium state, where things are pretty calm. The market is acting more like that passive mirror we talked about. But then you have far from equilibrium states. This is where those feedback loops completely take over, the engine really revs up, and this massive gap opens up between price and reality. And that, my friends, is where booms and bubbles are born.
Now, what's really fascinating here is the asymmetry of it all. The boom, right? It's fueled by that self-reinforcing belief, and it can build and build for a very long time. But the bust, that moment the belief shatters and the feedback loop slams into reverse, it's almost always sudden, sharp, and totally violent. The journey up the mountain is slow and steady, but the fall is terrifyingly fast.
And as Soros himself put it so well, the market's bias doesn't just show up in the price tag. It can actively change the fundamentals themselves. Think about it this way. The mood of the market isn't just a thermometer telling you the temperature. It's a thermostat, one that's capable of actually changing the temperature in the room. So the big question is, how can we actually use this powerful and, let's be honest, sometimes dangerous theory? Well, it's not really about predicting the future with perfect certainty. It's more about understanding the game that's actually being played.
Look, this isn't some magic formula, okay? It's more like a new lens for viewing the market. It teaches us to hunt for whatever the prevailing bias or narrative is, to be on the lookout for those really dangerous, far from equilibrium situations. But you know what? Most of all, it forces us to be humble, to step back and ask ourselves if our own beliefs are the ones getting caught up in the loop.
There's a reason Soros called his book The Alchemy of Finance. He totally understood that navigating these markets isn't just pure science. It's an art.
It's this incredible blend of data, psychology, and good old intuition. It really is the alchemy of turning human perception into financial profit.
And all of this really leaves us with a final, pretty provocative thought to chew on. If our collective beliefs are powerful enough to literally bend the reality of global financial markets, well, it kind of forces you to ask, right? And what other areas of our lives is that feedback loop between our perception and reality just as strong? What other worlds are we actively creating right now just by believing in them?